This is the Asia Trade. I'm Shery in Tokyo.
And I'm Annabelle, Droulers in Hong Kong. The top stories this hour. A muted reaction in the Euro, with Marine Le Pen's national rally leading the first round of French voting in a major setback for President Emmanuel Macron. Also ahead, a mixed start to the new quarter for Asian markets as investors await data including the Caixin China PMI and Japan's Tenkan. Plus, we hear exclusively this hour from the Sumitomo CEO about his strategy for yen weakness and the energy transition.
And well, of course, election season is heating up, and this week we're firmly focused on Europe. We had the French parliamentary elections, a first round where the far right dominated. We're headed towards a final round on Sunday. But before that, we have UK general elections as well, and the expectation for that is that the Prime Minister's Conservative Party could see the worst electoral defeat in more than a century. But you can see there on those pictures, Marine Le Pen and the far right National Rally having really dominated this round.
Yeah, absolutely. Not just that focus on France, of course, it's that continued reaction we're getting, all the fallout really from that presidential debate, Biden versus Trump. Over the weekend, it's really been Biden's allies coming out in force to sort of close ranks around him as well and say that he has not only the cognitive ability, but the ability to lead for a second term. He's at Camp David this weekend. We know with his family the kinds of conversations that is still yet to be told. But what we do know is that whoever wins that race in November will have significant ramifications, not just for global markets, but also for the Fed.
Yeah, for monetary policy globally, right? Because this political risk that everybody's watching will have implications when it comes to national budgets, when it comes to national deficits as well. Right now, Bloomberg's quarterly guide showing that of the 23 top central banks around the world, except for the Bank of Japan, everybody is expected to cut rates within the next 18 months. Of course, we are also watching what's happening in Central Portugal this week, given that central bankers are gathered. The ECB has already cut rates. So far, it's been a little bit of unsynchronized moves around the world. Right now, we're watching the open across Asia. This is the setup. Chicago Nikkei futures now pointing to the upside of 0.3%. The Japanese yen having topped the 161 level just a few days ago. We're watching for that as we got a new currency chief in Japan as well, not to mention that we're going to get the Tenkan quarterly results when it comes to business sentiment within the hour. Sydney futures pointing to the downside as we follow as well what could be the China Open, because we had the manufacturing PMI contracting for a second month. But take a look at how U.S. futures are coming online. We have already closed out the quarter, the first half of the year, with 15% gains for the S&P 500. We're setting up for 0.2% gain when it comes to E-mini futures. But really, the Treasury market also, of course, very much in focus, Bell, given that we continue to follow, as we discussed, the Fed as well as other central banks.
Yeah, absolutely. And that focus, as you said, really on the French election and the results there, because we're hearing that Marine Le Pen's national rally has dominated the first round of that vote, setting its sights now on an absolute majority. Our EU economy and government managing editor Ben Sills joins us now from Paris. And Ben, thanks very much for staying up late for us. But let's just get to this victory, because it was very much precedented for the national rally going into this vote. How does it set us up then for the second round of voting as well?
Well, yeah, as you say, this was broadly in line with what we've been expecting. The polls coming into today showed that Le Pen was running kind of mid-30s, Macron struggling to get up to 20%. I think the main lesson for investors from what we've seen tonight is that the tail risks of the far left party making gains and being in a position to influence the government, that seems to be off the table. And also the upside scenario of Macron somehow or other being able to defend his own control of the parliament, that's off the table as well. So the question is now, can Le Pen win a majority next week, or do we go into some kind of gridlock?
How should we be factoring in the political risk that could arise from that Sunday vote as well, especially when in combination we also have the UK general election?
Yes, there's a lot of voting going on this week. I think that the main issue for investors really is what happens to the French budget. Even Macron has been struggling to bring down the deficit. The EU has started the excessive deficit procedure against France in the last couple of weeks. So that is the risk. The main fear would be for an emboldened far right to come in and start imposing all sorts of unfunded spending plans. That's what we saw with Liz Truss in the UK, and Rishi Sunak on Thursday is going to find out the consequences of that. That's not likely to happen in France because the Le Pen party have watched what happened in the UK, and they've also watched what happened in Italy, where Giorgia Meloni, also from a far right party, has come in with a really kind of orthodox economic policy. She's kept investors on side, and I think that if we do see a far right government, then all the signs are, from what they've been saying, that they're not going to do anything rash, at least on the economic policy side in the short term.
What could really, of course, stop Le Pen's party in its tracks, Ben, does come down to the sort of horse trading that we're expected to see over the coming days. So just how many alliances do you think are going to be formed here?
Yeah, so we've seen some initial manoeuvring from the party leaders coming out tonight. It's a super complicated system in France, but there's nearly 600 different constituencies. Probably half of them have got a three-way runoff. Most of the rest have got a two-way runoff. And in those 300 three-way runoff seats, the party that's running in third place is going to consider pulling out to help out the candidate best placed to defeat Le Pen. But that's a kind of an awkward manoeuvre because the far left is in the mix as well, and Macron is not comfortable with the idea of stepping back so the far left can get a run at it either. So the fact that we have these two extremist groups prominent in this election makes it pretty difficult to call.
Our EU Economy and Government Managing Editor Ben Sills, they are staying late for us, given that we're still digesting the French parliamentary elections, the first round, and we're headed for more voting there. For more, let's bring in our executive editor for Asia markets, Paul Dobson. And Paul, we really haven't seen that much of a reaction in the currency space. A little bit of a bid up for euro, but not significant. What should we be expecting as we have also the UK general elections coming up?
Well, first of all, yeah, a little bit of a lift for the euro. As Ben was saying, the French elections, c'est compliqué. There's lots of potential permutations still to play out, but the market is a little bit more encouraged by the results that it may be more difficult for Marine Le Pen and the National Rally to secure that overall majority that would really tip the parliament in a different direction. If you do get to an eventual result next week around this time that suggests some kind of gridlock in parliament, then maybe that's the best scenario for markets right now. So that's what we'll be looking for as we get to the European stock open and French bonds begin trading as well. Maybe a little bit of a reinforcement of that slightly more hopeful from a market's perspective look at asset prices. But there's going to be lots of volatility, that's for sure, all the way through this week when we get that horse trading and into the vote next week as well. For the UK side, I wouldn't think that that's too much of an uncertainty for markets because the polls are so clear about how badly the Conservative Party is going to do and how well the Labour Party is going to do. And that probably is already factored into the prices a long way in advance. So perhaps that might be the one area of the political debate where we don't have to worry quite so much about market volatility as we had with the not only the French vote, but also the US election debate at the end of last week.
Yeah, it's certainly quite, to use your word there, complicated as well, Paul, the outlook for Asian equities. Of course, we're going into a third quarter now. So what's the bigger determinant, do you think? What happens with the Fed and the expectations around possible easing versus the outlook for China's economy as well?
Yeah, China's economy is also a factor for us to take into consideration, with the PMI still pointing to weakness there. I think, it's kind of bumbling along, right? Everybody has in mind the country is targeting 5% growth, can probably just about get there so long as exports remain relatively strong. So don't know if that's a huge factor. It's obviously going to continue to weigh on markets, but and unless there's some kind of turnaround, maybe we get something positive from the third plenum that gives it a lift. Probably that's not the most important thing for global investors at the moment. Much more important, as you were saying, is what the Fed is going to do, what the US economy looks like, and what US inflation looks like. We've seen some signs of slowdown in the US economic numbers of late. If that points towards a soft landing, then that's good, and the Fed can begin to cut gradually. If it's a sign that the economy is starting to roll over, then that could be a worse scenario where the Fed has to cut more aggressively. That's not really something that the market is contemplating at this point, but it's something that we'll need to watch out for. And then coming into the background, I think, is just we're going to be looking more and more at this US election now and what that means for global markets, for local markets, and for all of that currency trading as well. That's going to be much more volatile as things swing backwards and forwards before we get to the big day.
All right, that was our executive editor for Asia markets there, Paul Dobson. As we said, that focus on PMI data from China. We have the Caixin manufacturing numbers coming out in just a few hours, but we also have the official data over the weekend, and it showed that the factory activity contracted for a second straight month in June. So, of course, a lot of concerns around weakness in the economy. But let's get more now. Our China correspondent, Min Min Lo, is joining us with the details. And Min Min, let's just start with those numbers from the weekend. So break them down for us.
Yes, so the manufacturing PMI stayed flat, 49.5, so second straight month of contraction, which again is a signal of weakness in an area that the government is really tapping on to help lift the economy. You have trade tensions as a challenge to those trade barriers erected against Chinese producers, and also it perhaps suggests that this weakness in domestic demand is also dragging on the supply side as well. We saw the gauges for input and output prices really falling slightly from May, which suggests slightly stronger deflationary pressure on factory gate prices. Now, when it comes to non-manufacturing PMI, that slightly missed expectations, coming in at 51. The expectation was, the expectation was 51 actually, and the actual was 50.5. So slightly missing expectations there. But I think what's most worrying is that construction sub-index, which fell the most. It had fallen by 52.3 from 54.4, and that is the weakest print we've seen since July of last year, and that suggests that those government-led infrastructure investment is perhaps slowing down a little bit, and those have been really critical for recovery. So overall, this suggests that bolder stimulus are needed, and talking about that Caixin index as well, I believe consensus is that it will weaken slightly from the previous month as well.
Busy weekend really for data, because we had some home sales numbers coming out as well. So what did they tell us?
Yeah, home sales declined by 17%, but the good news is that decline is slowing down, because in May the drop was 34%, so much sharper. Definitely a relief for the housing sector and the broader economy as well. Clearly, some of those measures, especially from the Tier 1 cities to ease home buying curbs, have taken effect. We saw some of these cities really slashing the down payment ratios and also either lowering or removing the mortgage rate floors to make home loans cheaper. And so in the first 25 days of June, we saw this 30% month-on-month increase for cities like Guangzhou and Shenzhen. But overall, still, investors do not think that it's enough to really turn the housing sector around. We have that PBOC plan to help introduce liquidity to buy back homes. It would inject about 500 billion yuan of liquidity, but there are strong calls for the government to double that to 1 trillion yuan to really mop up those excess housing inventory.
And Min, all of this is really coming at a time when we continue to see rising geopolitical tensions, especially around trade and tech. Beijing is just tightening its grip when it comes to rare earths. What do we know at this point?
Yes, China has approved its first comprehensive regulation governing the mining, smelting and circulation of rare earths. And according to the State Council website, those minerals belong to the country. No one individual or company can claim them, and there will be penalties introduced for those engaged in illegal activities. Government agencies will now control the total amount of mining and smelting that goes on. They will also establish a product traceability system, and this really comes, as you said, as this race for the tech sector and for EVs heat up, and there are all these trade barriers erected against Chinese producers, and obviously many of these minerals are very critical components into these cars and for the green transition as well. We are seeing more and more countries like Australia and Canada really trying to restrict Chinese investments into the critical mineral sector, and now China is finding its own way to try to protect their own mining industry as well.
Bloomberg's China correspondent Ming Min Lo with everything that's happening across China. And coming up on the Asia Trade, we'll be discussing those factory numbers that have contracted now for a second straight month. Moody Analytics shares their view of the economy. Also, we ask Capital.com whether they think the AI trend can continue to boost stocks. And TD Securities joins us to discuss the possibility of yen intervention. This is Bloomberg. You're watching the Asia Trade. Take a look at the week ahead. The economy and global rate path are in focus at the ECB forum in Sintra, Portugal. Investors will be watching comments from the chiefs of the ECB, Fed, and more. The annual Shanghai Cooperation Organization Summit begins Wednesday in Kazakhstan. China's Ministry of Foreign Affairs saying that President Xi Jinping will attend. The UK economy in focus as voters head to the polls on Thursday for the general election. Prime Minister Rishi Sunak's Conservative Party appears to be heading for its worst electoral defeat in more than a century. And on Friday, attention now shifting to a key U.S. jobs report that's expected to show both employment and wage growth moderating. And that's your week ahead.
Let's bring in Katrina L now, Director of Economic Research at Moody's Analytics. And Katrina, of course, it's an action-packed week, but one of the standouts on the calendar is the U.S. jobs report. Is this going to be a set of numbers and findings that you think that the Fed wants to see?
Oh, definitely. I think the Fed has a laser-sharp focus on that U.S. jobs report because I think what they're looking for is ongoing evidence of a sustained disinflation trend. They're not going to pull that rate cut trigger until they see that, and we're expecting that it will be a pleasing report for them. We're expecting that jobs will come in and slow to around 200 over the month. So that's a decent slowdown from the 3-month average, which is sitting about 250,000. But I think they'll also be looking at what happens with wage data as well, hoping that that will continue to cool. And our expectation is the unemployment rate will hold steady. But if it does tick that little bit higher, I think that'll be positive as well, because we do need to see that ongoing softening in the US economy, and that labor market data is a key input to determining how quickly that's occurring.
What about the possibility of a second Trump presidency? Do you think that that's fully been factored in yet? And how would that possibly complicate the path for Fed easing, do you think?
I think it's an ongoing issue, and I know that in the global economy we're incredibly cognizant of the fact that geopolitical risk is elevated. We've got ongoing tensions in the Middle East, Russia's invasion of Ukraine continuing, and those U.S. elections in November are another kind of risk that clouds the outlook, particularly given the U.S. relationship with China. It's already in the spotlight, and it's going to continue to remain in the spotlight right up to those U.S. elections. If we do see increased trade tensions lobbed on China coming from the US, then we know from the trade war back in 2018 that has unfortunate consequences, not just on the US and Chinese economy, but also on the global economy too.
Yeah. How big of a risk is for the global economy the deceleration that we're seeing in China's economy, especially with the latest manufacturing PMI numbers?
Yeah, that's a good question. So the manufacturing PMI data was disappointing because what we're seeing is that manufacturing, which is what the government is really, powering its recovery engine on, the data show for June that it remains below that neutral threshold at 49.5. But I think what's particularly concerning is those forward indicators as well. So new orders, new export orders all remained below that 50 threshold again for a second consecutive month. And, you know, given that weakness that we're already seeing in domestic demand, particularly household consumption, the government is really relying on manufacturing and exports to pick up the slack. But what we're seeing through these data points is that it's not actually there yet. And the demand both at home and abroad for those goods is too weak to be there. And I think given the increased reluctance from important markets for China, thinking here particularly like Europe and the US, unless we see a sustained pickup in domestic demand, then manufacturing has continued to lag and perhaps risk that 5% growth target.
So could we see something substantive coming out of the third plenum? We finally have dates for the middle of July. And my question would be also more specifically on what can we expect perhaps on monetary policy, because we saw really the PBOC governor signals that we could perhaps see the biggest rewiring of how they inject liquidity into the economy very soon.
Yeah, so our expectation is, and there's a lot of hope coming out of reform agenda, that we will see meaningful steps forward coming out of the third plenum. I mean, historically, the third plenum is really where we see a nice blueprint for how the economic policy agenda is going to, you know, evolve over the next decade. So the hope is that we will see meaningful shifts. But I think what we really need to be focused on is just how the government is going to support that lagging domestic demand. We know that households have particularly struggled in the absence or since, you know, COVID restrictions have let up. Consumer confidence is incredibly low. The government has said, look, we're aware that youth unemployment, for instance, is a problem, but we haven't seen those concrete measures on how they're actually going to be addressing that. So the hope is that we will see more support directed at the household sector. And let's not forget as well that the household sector is really struggling against that backdrop of the more severe and ongoing property market correction. So they really do need that support. But I think it goes without saying that we will see support for the manufacturing side of the economy. So the supply side continue to really clearly be there as China has made it very clear that they want to move up the value chain and continue to innovate.
Katrina, Director of Economic Research at Moody's Analytics. Good to have you with us. We have more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade, and we're counting down to the start of trading for the third quarter here in Asia. Taking a look at what we're seeing in futures this morning, and it's pointing to a session that's looking a little bit mixed. Of course, one of the key questions going into this next 3 months of market activity is whether the gains that we saw in the second quarter can sustain into the third. One of the key questions hanging over it is the health of China's economy. And we did see not only stocks entering a technical correction last week, but concerns as well really indicated in the PMI numbers that came out over the weekend. The private survey is due in just a couple of hours. We've got contracts for S&P 500 pointing to a slight drop. Japan, US futures, a little bit more positive.
You're watching the Asia trade. Japanese markets. You're watching the Asia trade. Japanese markets opening at the top of the next hour. And of course, we're watching right now how futures are setting up upside of 0.8%. Of course, we had gains in the previous session. This would be the first trading day of the second half. Already in the first half, we saw double-digit gains for both the Nikkei and the Topics. The Japanese yen holding very close to 161, a level that is surpassed on Friday already. And of course, we continue to be watching those JGB yields, given that we're expecting perhaps some moves from the BOJ come July. Bloomberg senior Japan economist Taro Kimura joins us now along with with Asia Economy and Government Senior Editor Brian Fowler. Let me start with you, Brian, because, of course, the latest that we've heard is as we continue to watch for any intervention coming from authorities, that we might potentially see, that we have already seen a new currency chief, and that would be Atsushi Mimura. Tell us a little bit about him.
Well, let me just say, okay, first of all, Shery, I mean, this is obviously a very dramatic time to be making a change at that position, but it's part of normal rotations. And the one thing you can bet on is we will see continuity. The scripts that the MOF officials deliver are always meticulously prepared, and you'll notice on days when we have Suzuki and Kanda speaking on the same day, they always convey the exact same amount of urgency, whether it's something simple like we are watching currency markets regularly, or more dramatic, more urgent, we are ready to take steps as necessary. So that won't change. The one thing that does change is there is communication involved with the media, and having seen dozens of vice finance ministers come and go in my time, I mean, I can say they're all the cream of the crop. They're all fantastic. They've got great English. They know everything about the world and the financial markets. But charisma is a thing, and Kanda had a degree of charisma that reminds me of something we haven't really seen since the days of Eisuke Sakakibara. I mean, a real...
Mr. Yen, as he's been dubbed.
A power over, the timing is always exquisite, the way they deliver their communications. So that's something to watch. We'll have to see just what Mr. Mimura looks like when he starts talking with the press on a regular basis.
I gotta say, though, despite the charisma, I mean, that hasn't really necessarily worked in the last few months. We saw what happened last week as well. He was talking about intervening for 24 hours, and then the yen just didn't budge. But, Taro, that's led to some different dynamics across the Japanese economy, including prices now continuing to rise.
Right, absolutely. So BOJ's stance was they don't care about the levels of the yen, but the yen is kept in that weakness so high that that will be something that the BOJ can't ignore. And I think the weaker yen is make their guards up about inflation overshooting. And obviously the Tokyo CPI Friday suggests that inflation is going in the BOJ's direction. So I think those readings are kind of opening the gates for the BOJ for its another hike in July in my reading. Yeah.
So why hasn't the government intervened so far, Brian? Because we have seen, of course, as Taro says, very weak levels. Is it the gradual decline that's really keeping authorities at bay?
Yeah, I mean, part of it's the pace of the move, so that's definitely something they're watching closely. And it's also, I mean, they're looking at, everything, the macro environment, and they can't fight the Fed. The main factor that's pushing the dollar up, and it's up not just against the yen, but up against all the other currencies as well, is Fed interest rates. So Japan has to kind of time its moves and really, make the most of its efforts. It doesn't want to intervene at a time when it's just going to be pushing against a string, so to speak. So we're still on standby anytime, and we're watching closely, and I think it's just a matter of seeing how the market is positioned on any day.
Taro, what's your outlook for the yen as we head into a new quarter? Because part of the moves and that weakness we've seen in the Japanese yen have also been attributed to funding needs for the dollar at the quarter end, rebalancing of portfolios, especially given the US PCE reading on Friday. Do you see that pressure being eased a little bit in the coming couple of weeks?
It's really hard to say because the recent weekend is mostly about the speculative pressure. People say carry trade is about fundamentals, but to my eyes, the carry trade is also mostly speculative because it try to retain not only the rate differentials, but also it actually targets the capital gains. So therefore, as long as those capital speculative pressure goes on, the dollar yen could blow it to anyway. That said, I think the Japanese investors are seeking the time for repatriation. That will not be a strong game changer, but somehow a supportive factor for the yen, I think.
Tara, we have the Japan Tankan Business Sentiment Survey coming out within the hour. It's been interesting talking to these CEOs because even exporters who benefit from a weaker yen are feeling a bit more cautious when it comes to this much weakness.
Right, absolutely. Obviously, like even the importers, even the exporters procure by imports because, like, you know, the Japan's lack of resources, and they generally so that's why I think their message is kind of weakness of yen probably went over that sort of threshold for the profit, and also obviously for, let's say, for the car makers, you know, if the consumer confidence is declining, that makes worse for their domestic businesses as well. So that's why I think they're alerting to the weaker yen. For the tank, I think the inflation-related gauges are must-watch. Whether particularly the service providers are still willing to raise prices, and also the corporate inflation expectations are one of the most important gauges for the BOJ to watch the inflation expectations. If it's kept around 2%, it's like another go for BOJ's hike in July.
Brian, what are your expectations as well for that survey and the type of confidence we're expecting to see from businesses?
Well, I mean, we're prepared for all possibilities, but we expect to see the Tankan sentiment broadly holding steady across all sectors. You'll remember that the services sector, we were at the highest in decades before, so we'll be watching that closely to see if that is maintained. We expect manufacturers to kind of come in about where they were, which is, as Taro said, I mean, it's broadly should be supportive for the BOJ to certainly consider and possibly execute a rate hike at the end of this month. We'll also be looking at CapEx. We expect CapEx figures for this fiscal year to be revised up into the double digits, somewhere around the 13-12% range. That'll be a big sign of positive sign for the BOJ in terms of the virtuous economic cycle that it's been pursuing.
Bloomberg's Brian Fowler there and Taro Kimura joining us in the Tokyo studio with that conversation on the weakness of the Japanese yen. And one of those companies that I mentioned earlier that's worried about this persistent weakness has been one of Warren Buffett's favorite Japanese trading houses, saying that a weaker currency has some upside for the company, but is worrisome for the future of Japan. We spoke exclusively with Sumitomo CEO Shingo Ueno about the firm's strategy and expansion plans as well amid yen weakness.
Last 3 years, we have been working for the structural reform. So now it's changed the mood. I would like to change the mood from defense to offense. So in other words, you know, we will have to realize the dramatic growth in next 3 years. That's why I try to change our company's mindset. Then the main theme is number one in each business line. So that's a kind of that mindset. But at the same time, I would like to, accelerate the reallocation of our management resources into the focus area. That's the main part.
Tell us a little bit about those focus areas, because as you said, you have so many different business lines.
Exactly. That's right. Yes. There are, especially there are 8 business lines: real estate or steel businesses, healthcare, agriculture, so many things. Just I pick up 3 examples. One is agriculture business, agri businesses. We are doing the fertilizer or biochemical that we will expand to the seed sales, or in addition to that, the other type of the agricultural products we are now selling in the Latin America, in Europe, and we would like to expand. That's the first one. And second one is the construction machinery businesses. Historically, we have been working in Canada and the United States. It's a sales and also the rental business. The rental business will be expanded to the Singapore and other Southeast countries, and then we are targeting to the Europe. That's the second one. The third one is the real estate that we would like to develop the city or urban development project centered on real estate. That's what we are targeting. All those 3 has the strengths, experience, or competitive advantage.
When you're talking about expansion in your business,
yes.
Are we talking about growth coming organically or even through M&As?
Even through M&A.
How would a very cheap Japanese yen play into that strategy? Because M&As become more expensive when the yen is this weak.
Exactly. However, we just count on that dollar basis. So that's why nothing changed, regardless of the yen depreciation or appreciations. We would like to see what is the value in dollar, and then we will decide to invest into those businesses or not. So then, at the same time, the businesses where we are confident will increase the corporate value, that company's value. Then we decided to go into the investment.
Does that mean that so far you're not seeing a meaningful impact from the depreciation of the yen?
I don't think so.
Do you expect to see more meaningful impact? Because I know that your yen assumption for until March of 2025 was 140. We're around 160 and people are talking about 170.
I know. When I made that midterm plan, our assumption was that the U.S.-Japan interest gap will be narrower at that time. But actually, as you said, that the yen is depreciated further. So I'm not sure what will happen in the future. But I think the interest gap will be slowly narrower, and then yen depreciation maybe change to the appreciations. But I think it is good for our company to some extent, because that the yen is depreciated, and 1 yen maybe how much? 2 billion? No, 2 billion yen increase.
A depreciation of 1 yen would actually equal to 2 billion yen
increase
in profits.
In profit. However, such a prolonged, say, Japanese yen depreciation will not good for the country's strengths in the long run,
That was the Sumitomo CEO Shingo Ueno speaking exclusively with Shery in Tokyo. And let's take you to some live pictures now from Hong Kong, because we've got the 27th anniversary of the establishment of the Hong Kong Special Administrative Region taking place today. So this is the day, of course, where we see Hong Kong marking the handover of the anniversary from Britain to China here. But this ceremony just starting, it is expected to be attended by the Chief Executive, Mr. John Lee, senior government officials as well. So flag raising ceremony starting in about 15 minutes from now. But we'll have more ahead and we'll take you back to those live pictures. This is the Asia Trade.
South Korea set to extend trading hours for its currency from today, seeking to boost foreign market access. For more, let's bring in Asia FX and rates reporter Hoo-yeon Kim. Hoo-yeon, of course, we have seen incredible pressure on most Asian currencies, including the Korean won, very close to that 1,400 level. What can we expect this week?
As of today, South Korea is extending its local trading hours for its onshore currency as part of a round of a bunch of other reforms that are taking place in efforts to give foreign investors more access to its financial markets. The extension will be by 11.5 hours. So currently, the local foreign exchange market closes at 3:30 p.m. That will be extended to 2 a.m. the next day.
And Hoo-yeon, of course, there's been a lot of anticipation for this, and sort of lengthening those trading hours is sort of seen as a positive, or overall a positive. But what do the changes mean exactly for Korean markets?
The extension of trading hours is expected to help improve the FX market's accessibility. and move the country closer to getting its stocks and bonds added to global indexes like the FTSE Russell's World Government Bond Index. That's projected to lure more foreign investors into the country and help improve the nation's fundraising capabilities. For global traders, the extended hours would hopefully give them more access to real-time quotes and better prices.
That was our Asia FX and race reporter Huyun Kim there joining us. And it is that countdown as well, about 15 minutes away from the open of equity markets in Asia. Start of the third trading quarter as well. But what we're focusing in on, of course, you can see that the Japanese yen holding close to that 161 question, as well as whether that weakness continues to be a net positive for Japanese exporters. We did see Japanese equity markets, the world's best performers in the first half. Today, we are pointing to some future gains there or further gains. US futures as well coming online to the upside here. Aussie equities, though, it's a bit of a different story, reflecting some weakness. And Shery, perhaps the concerns around China's economy, given those PMI numbers over the weekend.
Yeah, I mean, a second month of contraction when it came to the manufacturing PMI, right? And what happens also to the exporter-oriented Caixin PMIs coming out today will be a key question. Of course, we have seen that weakness really across the board in China, especially given the ongoing housing slump. But that a sub-index of new orders at factories inching down has been really a precursor of what might go wrong in the manufacturing sector in China, especially as we are expecting perhaps more trade tensions as the election season heats up. We do have, of course, the U.S. presidential elections in November, and already the pressure on Beijing when it comes to Europe and EV makers as well. Well, other corporate stories that we're following at this moment, Bloomberg now learning that BlackRock is close to a $2.5 billion deal to buy private capital database provider Preqin. Sources say BlackRock outbid rivals to emerge as the likely buyer. Any deal may be announced as soon as Monday. The company competes with Bloomberg LP, the parent company of Bloomberg News. Anglo American has suspended production at its coking coal mine in the Australian state of Queensland due to an underground fire. The company says all workers were safely evacuated from the Grosvenor mine after coal gas ignited on Saturday. Residents of nearby towns have been warned to stay indoors as thick smoke pours from the mine. We have more ahead on the Asia trade. This is Bloomberg. We do have breaking news out of Japan. We are getting the Tankan Business Sentiment Index for large manufacturers coming in at 13. The expectation for the second quarter was only of 11, and the previous quarter we also saw it at that 11 level. So, in fact, this is really an improvement in business sentiment for large manufacturers. When it comes to large non-manufacturers, it's coming in at 33, a little bit of softening from the previous quarter and in line with expectations. Of course, we were watching the manufacturing index given that manufacturer sentiment had been hit by that car safety scandal, but the production seems to have rebounded. So the manufacturer sentiment side of things has improved when in fact the non-manufacturing side of things has also been lifted because of the inbound tourism that we're seeing. But really interesting, Annabelle, when it comes to the manufacturers' expectations for dollar yen for 2024 are still at 144.77, and right now, of course, we're at that 160 level, Belle.
Yeah, even approaching 161. But let's take you back to those live pictures from Hong Kong, because you're seeing here the chief executive, John Lee. He is in attendance down in Wan Chai actually this morning, but this is an event for the 27th anniversary of the establishment of the Hong Kong Special Administrative Region. We've got a flag-raising ceremony that's kicking off in just under 10 minutes from now. We have seen some marching going underway this morning as well. But it is marking, of course, the occasion of China's, or Hong Kong's return, rather, to Chinese sovereignty. And that's something that our Bloomberg Originals team has been looking at, how the city is becoming more aligned with the mainland and what, of course, that means for its future as an Asian financial hub. Here's a preview.
When Hong Kong was handed back to China after more than 150 years of British colonial rule, Beijing promised a high degree of autonomy in its economic and political systems for 50 years. The city cemented its status as an international financial hub and one of the world's freest economies, bolstered by its rule of law, a free internet and press, and a currency pegged to the US dollar. But at the same time, tension had been simmering between Beijing and Hong Kong's political opposition, which wanted to expand civil liberties. In March this year, Hong Kong introduced its own security legislation. New crimes like treason and insurrection carry life sentences.
The threat to national security is real.
But it wasn't just increased restriction on free speech and expression, bringing Hong Kong closer to the mainland. In 2017, President Xi Jinping unveiled the Greater Bay Area Development Project, an effort to integrate Hong Kong with Macau, Shenzhen, and nearby cities.
The dilemma for Beijing is that the crackdown on political dissent has meant that people increasingly view Hong Kong as similar to mainland China. It's its differences that have really secured and underpinned the success of Hong Kong for many, many years.
Subscribers can see the documentary in full right now on the terminal on Bloomberg.com and also available on the Bloomberg Originals YouTube channel. As we continue to show you live pictures outside of the Hong Kong Convention and Exhibition Center, we're awaiting that flag-raising ceremony. We already saw senior government officials walking around that region. We are now expecting really officials to celebrate the 27th anniversary of the establishment of the Hong Kong Special Administrative Region. We had just seen Chief Executive John Lee. We are expecting officials to also head inside of the Hong Kong Convention and Exhibition Center in Wan Chai for a reception at the Grand Hall as they celebrate the 27th anniversary of the establishment of Hong Kong. We do have the market opens in Sydney, Seoul, and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. The first trading day of the second half. Of course, we already saw solid gains when it comes to U.S. markets. Also here in Japan, double-digit gains, Bell, as we continue to see business sentiment pretty solid among large manufacturers.
Yeah, that's right. Those manufacturing numbers, or rather the Tankan survey coming out in just the last few minutes, and we're seeing that large manufacturing reading picking up to 13 from 11 in the prior month. But there's that focus on the eco front. There's also a lot of election risk in the days ahead as well.
And of course, we're still awaiting export numbers out of South Korea for more indication of where the economy globally goes, right? Such a great indicator when it comes to demand globally. We are seeing South Korea's June exports rising 5.1%. The estimate was for gains of only 4.4%. The trade surplus also widening to $7.99 billion from $5.7 billion. And imports have fallen 7.5% year on year, which is a bigger fall than what was initially expected. But suffice it to say that we are seeing South Korean export growth being pretty strong, despite the fact that we're factoring in perhaps for a little bit of weakness, given that June does have fewer workdays in the country, but still the underlying momentum seems to be strong enough that the export numbers have actually beat to the upside of gains of 5.1%. And you can see the Kospi, though, coming online with a pressure of about 0.1%, while the more tech-focused Kosdaq right now is unchanged. But the really focus right now on the weakness of the Korean won, because we're headed towards that 1400 level as well, and we continue to see weakness. Of course, perhaps not surprising given that we have seen a stronger U.S. dollar broadly after 6 straight weeks of gains. Take a look at how Japan is now setting up, because we have seen the Japanese yen topped that 161 level just a few days ago, and right now trading still around the 1986 lows against the U.S. dollar. Of course, we'll be watching what the new currency chief strategy here is when it comes to trying to push back against this weakness at a time when the weakness is also helping a lot of sentiment across some of those large exporters. We have seen Tankan's June large manufacturing index at 13, beating expectations and improving from the previous quarter. Surprising and perhaps a little bit interesting that manufacturers see still the dollar yen at 144.77 in 2024. So you can see really the incredible weakness that was unexpected even by the largest corporations in Japan, Belle.
Yeah, and so much of that weakness really comes down to King Dollar and the story that that dynamic is telling us. But let's take a look at how markets are as well coming online this morning for Australia. So far, the S&P 500 is starting fairly flat. Of course, it's a staggered start. We'll get that full picture, but futures have been telling us we've seen a drop of around 0.5%. It could be sort of that China story that plays into it. As we said, we had the official gauge for manufacturing PMI coming out over the weekend. It showed us that shrinkage that we're seeing in the mainland economy. What else we're tracking in the session today is the outlook for bond yields. We saw that rally in U.S. Treasuries really losing momentum on the final trading day of June. Yields actually extended their climb so far this morning, coming online fairly steady here, though we are seeing that reaction again coming in Aussie bond yields instead. But let's as well take you back to some live pictures of Hong Kong, because we do have the 27th anniversary of the handover from Britain to mainland China. Right now we've got a flag-raising ceremony that's just getting started here. We do have this ceremony as well being attended by the chief executive, John Lee. We've already seen pictures of him there, as well as senior government officials. So they've got this ceremony. There's going to be a reception to follow, and Hong Kong markets, to note, they are shut Monday for a public holiday, Shery, in turn.
Yeah, and of course, we'll continue to watch how the Hong Kong economy will really be affected by what's happening in the mainland, right? Given that we have seen the factory activity numbers across China contracting for a second straight month in June. Let's bring in our next guest. Kyle Rodda is senior market analyst at Capital.com. And Kyle, of course, we were talking about some of the risks for the economy in China, in Hong Kong, but also, of course, geopolitical risks continuing to rise, whether it's trade tensions or really the rivalry around tech, or even what's happening across Europe. Is it not surprising then that we're seeing this strength in the dollar as well?
No, not surprising at all, and especially when you combine with the fact that, we're seeing some signs of cyclical weakness across the globe, and certainly a patchwork global economy, which, is clearly indicating some tepidness in the Asian region, especially generated from China. That's spilling over to Europe, which, obviously is seeing a weaker euro because of some of these, existential risks at the margins, rising again for the European Union, which haven't existed for pretty much, 4 or 5 years, at least since the start of the pandemic. There's no surprise that with such a strong US economy and in that backdrop that we're still seeing, continued upside in the US dollar. The question obviously becomes, does this continue? And there's the prospect that we start to see maybe some, weakness coming back through the greenback if, this continuation of the disinflationary trend, persists. That, obviously was revealed in the PCE data on Friday night. But I mean, overall, at the moment, the markets are drawn to areas of the global economy which are strong. That, despite obviously a lot of the political risks emerging in the next few months around the US election, will kind of cast a little bit of a shadow over US markets and the US dollar. Overall, that kind of desire for safety and economic outperformance is keeping the greenback well bid. So again, no surprise. We might see that trade unwound a little bit to start the week, because it seems to be a little bit of a relief rally after at least that kind of French parliamentary election, while not moving in the direction that's necessarily positive for the euro, takes that kind of one unknown off the table for now, and it can be priced in. So that sort of shorter term dollar weakness could sort of start coming through to start the new quarter. But nevertheless, the fundamentals for the US dollar are far better than any other sort of G10 economy at the moment. And there's no surprise why we're still seeing that kind of uptrend in the greenback.
So far, we have seen these moves by central banks around the world being pretty unsynchronized. I mean, we talked about the French elections, and around the ECB, we saw already the first rate cut, but the Swiss National Bank has already cut twice. When these moves become more correlated, Is that still going to lead to more dollar strength, or could we see that subsiding a little bit for other currencies to gain some foot here?
I think when the Fed actually does start to ease, and I mean, I think the question after the PCE data on Friday night and, you know, going into this NFP's release on Friday is whether September is going to be a live meeting. At the moment, we've got the markets pricing in, you know, basically 50-50 odds, slightly better than that the Fed will be able to cut in September. If those odds start to increase, you're looking at a situation where global financial conditions can ease, and there's a confidence there that, you know, the sort of inflationary dragon has been tamed to some extent, or at least the Fed has the capacity just to incrementally lower rates to keep real rates at a fairly steady level. And that's going to have a positive impact on financial conditions, especially in Asia, which has obviously caused a lot of stress in terms of emerging market currencies in this part of the world, but obviously too on the yen and the yuan as well. And we'll also have the capacity too just to kind of, you know, narrow those yield differentials against some of those other major, say, G4 currency pairs, looking at the pound and the euro. And sort of there'll be that kind of catch-up play with the Fed starting to kind of cut in line with what we're seeing with some of those other major central banks. So I suspect that is a turning point. But as we know, it's very data dependent. We're following the Fed. The Fed's data dependent. That's been, you know, clear over the last few weeks, even despite sort of changing Fed projections and Fed rhetoric. So once we start to see the Fed feeling reasonably confident that it has the capacity to lower rates, again, just to keep real rates fairly steady at sort of on the 10-year, sort of 2.25%, give or take, you know, 20, 30 basis points. That's going to be a bit of a green light, I think, for you know, other G10 currencies to appreciate, the dollar to pull back somewhat. But again, it all depends on that data coming through. At the moment, the data is positive. I think the real question now, given, again, that Friday night number, is whether September is a truly live meeting and whether the cutting cycle, as shallow as it's likely to be, starts to continue, begins at that particular meeting.
And that possible Fed easing, is that going to be enough, the equity market reaction in Asia, to offset concerns around China's economy? Because the PMI numbers from over the weekend didn't look that great.
The short answer is yes, at the margins it will. I think there are a few things to note on that. Is that if you get easing in the United States, financial conditions are going to ease enough globally and valuations are going to ease enough globally to be able to support markets. And, you know, obviously part of that too is just simply the fact that if the Fed is easing, it's because inflation is coming back down to target, and some of those risks of requiring higher for longer monetary policy will diminish, and we'll start to see sort of some favourable conditions emerging for investors. Equities becoming relatively more attractive on the basis that yields will probably start to come down, and, you know, some of those valuation pressures that we are seeing in some pockets of the global economy at the moment and in global markets, which would suggest in the long run risk reward in equities isn't particularly favourable. They'll become more favourable just because those yield spreads will be a little bit more attractive, assuming obviously all else being equal. But on top of that, just speaking specifically to the Chinese markets, you know, one of the big things that are really you know, driving some of this weakness that we've seen for some time in China in particular is some of these concerns around systemic risks, tight financial conditions. That's obviously manifesting in the yuan, but also obviously on the impact that higher yields have on still very a sensitive economy to dollar-denominated debt, even though they have obviously reduced their treasuries quite significantly. If we see anything that takes some of that pressure off global financial conditions, that'll take pressure off some of those systemic risks in China, and that'll give investors a little bit of confidence to sort of move into assets that are still, you know, historically speaking, undervalued, despite the fact that fundamentals are still weak there. So again, we're talking about things at the margins here, but anything that sees global financial conditions ease a little bit because of that inflation coming down will ultimately have positive knock-on effects, or a cascade effect, a trickle-down effect to markets in the region, and I think in particular to equities in China.
Well, equities in China and the economic health, of course, there's that knock-on, there's that cascade effect for Australia in turn, and we've seen the pullback in Aussie equities, but do you think even with that, do they look attractive to you right now?
I think they remain reasonably range-bound, and justifiably so. I mean, if you look at the drivers of Australian equities, I mean, it's such a simple kind of rubric to follow, but banks, miners, the cyclical elements of the market still look fairly weak, and they will likely remain fairly weak because the economic cycle, although picking up slightly over the last few months, isn't really indicative of a global commodity upswing, at least in the short term, especially when it comes to iron ore and things of that nature. Then you look at things like the banks and the domestic economy, fairly weak. We're also looking at the prospect of a potential rate hike in August in Australia as well, which at the moment is more or less interest rate market's base case if you look at what's priced in the curve. So there doesn't seem to be, for now, and again, all else being equal, anything very cataclysmic on the horizon for Australian equities. But if you look at valuations at the moment, really unattractive. You know, you've got effectively a negative yield premium on equities compared to bonds at the moment, which will only get compounded if we happen to see an interest rate rise in August. And given the fact that we're not really seeing a really big cyclical upswing in China and almost a reluctance from Chinese policymakers to kind of run any really strong counter-cyclical policy, which would typically be favourable for Australian equities, it's hard to see Australia breaking the ASX 200 breaking out of this recent range. If anything, they remain unattractive compared to the rest of the world. So there's not really much of an argument for flow to move into Australian stocks at the moment. And again, you just couple that with some of the domestic risks around recession as well as interest rate rises because of this, uptick we're seeing in inflation. It's just not a pretty picture at the moment for the ASX 200.
Rodda, good to have you back. Senior market analyst at Capital.com, and still ahead, we also speak to TD Securities about the possibility of a yen intervention as the Japanese currency trades near 38-year lows. And we'll also be speaking a little bit more about those factory numbers that we got from China. Activity contracted for a second straight month in a warning for Beijing's strategy to revive the recovery. This is Bloomberg.
You're watching the Asia trade, and we're set to get the latest Caixin manufacturing PMI from China in the next hour. Beijing's latest official data showed factory activity contracting for a second straight month in June, which signals weakness in the economy. Let's get more with our China correspondent Min Min Lo joining us with the details. And Min Min, let's just start with the official numbers from the weekend. What exactly did they signal to us?
Yeah, so PMI data stayed flat from May, contracting for a second straight month. And you're right, this is an area, manufacturing is the area that Beijing has been really betting on to help lift the rest of the economy. But it looks like this slowdown in domestic consumption is perhaps really hitting the supply side as well. We saw gauges for input and output prices falling slightly in June, which perhaps suggests mildly stronger deflationary pressures on factory gate prices as well. And again, you also see these trade tensions ratcheting up with these trade barriers erected against Chinese producers, and that's why we're seeing the Caixin forecast as well, which is a more export-oriented forecast for Chinese manufacturing. That is expected to slow down from the previous month. Now, if you look at the non-manufacturing PMI, that has missed expectations slightly, coming in at just above 50. The expectation was 51, but perhaps the most worrying is the construction sub-index, because that's where we see the biggest drop to 52.3, down from 54.4, and this is the weakest print we've seen since July of last year, suggesting that those government-led infrastructure investment is perhaps losing steam a little bit, and so more stimulus will be needed. And there are two things that can change this. One is that July plenum coming up, we could see more confidence-boosting measures from there, and the other is that PBOC buyback scheme of unsold homes. If that is expanded, we could see construction sub-index moving up as well.
Yeah, given everything that you've just told us, perhaps not surprising then that home sales continue to slow?
Yes, so home sales is down 17% in June, but the good news is that decline has slowed down, because the previous month home sales was down 34%, so it was much steeper decline in May. So this is good news for the housing sector and for the broader economy as well. Clearly, some of those home buying curbs that has been eased in the Tier 1 cities, those has taken effect. We have seen cities like Shenzhen and Guangzhou and Shanghai as well really either lowering or removing those mortgage rate floors to make home loans easier and slashing down payment ratios as well. And that's why we saw this 30% jump in home sales in the first 25 days of June. In places like Shenzhen and Guangzhou, Shanghai saw slower gains of 11%, but it's good news overall. But investors and economists think we're not out of the woods yet. Again, that PBOC plan to buy back unsold homes, they are calling for that to be doubled, for the PBOC to inject double the amount of liquidity to help buy back unsold inventory. And of course, we have many of these distressed developers, many of whom have been really in default for more than a year. They are really banking on this revival of sales to help persuade debt holders and to fight off their liquidity, their liquidation.
Our China correspondent Mimi Lo there with the latest on the Chinese economy, as of course we continue to watch the weak Japanese yen as well. Coming up, hear why Sumitomo is saying that a cheap currency has some benefits for the company, but is a problem for the future of Japan. Our exclusive interview with their CEO Shingo Ueno is next. This is Bloomberg.
In an unambiguous vote, the French people have demonstrated their desire to turn the page after 7 years of contemptuous and corrosive power. We warmly thank the voters and welcome this result. This first step towards choosing an alternative is a mark of confidence which honors and obliges us.
That was Marine Le Pen there from the National Rally, speaking after the results of that first vote going in and telling us that, yes, we did see Marine Le Pen scoring a victory, but perhaps not as big a one as had been expecting, or we had been expecting. So perhaps we're setting up really for a week of horse trading where we're going to see a lot of alliances being formed to weaken the appeal of the far right. The market reaction to this is pretty clear, because you are seeing that noticeable difference really in Bund futures versus what we see in French bond futures instead. French bond futures little changed, Bund futures noticeably lower, tells us we could see that French-Germany yield spread narrow a little bit. Shery.
And Belle, of course, we're also watching one of Warren Buffett's favorite Japanese trading houses saying that a weaker Japanese currency has some upside for the company, but he's worrisome for the future of Japan. We spoke exclusively with Sumitomo CEO Shingo Ueno about the firm's strategy and expansion plans amid yen weakness.
Last 3 years, we have been working for the structural reform. So now it's changed the mood. I would like to change the mood from defense to offense. So in other words, we will have to realize the dramatic growth in next 3 years. That's why I try to change our company's mindset. Then the main theme is number one in each business line. So that's a kind of that mindset, but at the same time, I would like to, accelerate the reallocation of our management resources into the focus area. That's the main part.
Tell us a little bit about those focus areas, because as you said, you have so many different business lines.
Exactly. That's right. Yes, there are. Especially there are 8 business lines. Real estate or steel businesses, healthcare, agriculture, so many things. Just I pick up 3 examples. One is agriculture business, agri businesses. We are doing the fertilizer or biochemical that we will expand to the seed sales, or in addition to that, the other type of the agricultural products we are now selling in the Latin America, in Europe, and we would like to expand. That's the first one. And second one is the construction machinery businesses. Historically, we have been working in Canada and the United States. It's a sales and also the rental business. The rental business will be expanded to the Singapore and other Southeast countries, and then we are targeting to the Europe. That's the second one. The third one is the real estate that we would like to develop the city or urban development project centered on real estate. That's what we're targeting. All those three has the strengths, experience, or competitive advantage.
When you're talking about expansion in your business,
yes.
Are we talking about growth coming organically or even through M&As?
Even through M&A.
How would a very cheap Japanese yen play into that strategy? Because M&As become more expensive when the yen is this weak.
Exactly. However, we just count on that dollar basis. So that's why nothing changed, regardless of the yen depreciation or appreciations. We would like to see what is the value in dollar, and then we will decide to invest into those businesses or not. So then, at the same time, the businesses where we are confident will increase the corporate value, that company's value. Then we decided to go into the investment.
Does that mean that so far you're not seeing a meaningful impact from the depreciation of the yen?
I don't think so.
Do you expect to see more meaningful impact? Because I know that your yen assumption for until March of 2025 was 140. We're around 160 and people are talking about 170.
I know. When I made that midterm plan, our assumption was that the U.S.-Japan interest gap will be narrower at that time. But actually, as you said, that the yen is depreciated further. So I'm not sure what will happen in the future. But I think the interest gap will be slowly narrower, and then yen depreciation maybe change to the appreciations. But I think it is good for our company to some extent.
That was the Sumitomo CEO Shingo Ueno speaking exclusively with Shery in Tokyo. And we're going to have more ahead on the Asia trade. Of course, trading getting underway for equities across Japan, Korea and Australia. And so far, the session looking a little bit mixed, but upside there for the Nikkei 225.
Take a look at the early trading session across Asia, the first trading session of the second half, and we're seeing the Nikkei gain 0.8%, extending those gains that we saw in the previous session and really extending the gains that we saw in the first half. We are seeing gains of around 18% for both the Nikkei and the topics, but of course the focus very much on what's happening with the Japanese yen, given that we surpassed at one point the 161 level. Are we going to see intervention is a key question. The weak yen has already helped some of those large manufacturers. The Tankan survey coming in at 13, which is an improvement from the previous quarter. We're also watching the Kospi, which is under pressure right now. We did get some solid export numbers for the month of June. We're talking about growth of more than 5% and surpassing expectations, despite the fact, Bell, that we actually saw fewer workdays in the month. So the underlying momentum is still there.
Yeah, and Shery, of course, you take a look at what's happening in the chip space as well, and exports hitting a record over the month of June, so coming in at $13.4 billion. It's really playing in actually to the PMI readings we just got out as well, because South Korea has seen an acceleration here, or a pickup in that latest survey, so coming in at 52. That was the reading, up from 51.6. The results actually are pretty mixed so far. You are seeing, again, chip theme, better numbers coming through, and a big pickup from Taiwan to 53.2. From 50.9, but it is a deceleration in some parts, particularly those economies that are more exposed to the health of China. Malaysia, for instance, you're seeing it actually dropping below that key 50 mark, and again a bit of weakness coming through for the likes of Indonesia as well. But that's the readings there we're getting for Asia's PMI. Certainly a check on the health of Asia's manufacturing sector Let's also take a look at what's happening in the FX space this morning, because following the Fed's preferred inflation gauge on Friday, we did see a little bit of dollar weakness coming through. Today, the story, though, is Asian currency weakness for the most part here, and some very key levels that we're watching as well. You've got the Japanese yen holding above that 160 mark, very close to 161. You've got as well the offshore Chinese yuan heading very close to 7.3, and of course continuing to track the Korean won there, given we've got the start of extended trading hours. Certainly something to be watching as well as Korea starts to internationalize its currency markets. But let's bring in Alex Liu. He's our FX and macro strategist at TD Securities. And Alex, it seems like really the dollar just remains that only game in town, especially ahead of the US election.
Yes, Annabelle, it is true. We do like the dollar going into the second half of the year, but oh my gosh, what an exciting first half that has been. Going into the second half, there is a lot of election uncertainty, and we think that the dollar will be, the best risk-off hedge going into the second half of the year. It is, has a very strong carry profile, and we do like its appeal as a safe haven currency. So all that bodes very well for the dollar into the second half. And against the Asian FX complex, we do see Asian FX trading at very, very pivotal levels, like you said.
So what's your expectation then, or your thinking around, for instance, where the Bloomberg dollar gauge ends by December?
So I think, for the Bloomberg dollar gauge, we see another 2.5% upside towards year end. We see euro going to 103 and dollar CAD going to 140. Obviously reflects in the dollars, the market's pricing in more premium for uncertainty going to the election in November. So all in, we really do see more dollar upside going into the second half. And for the currencies, Asian currencies complex, that means that, dollar Korea and dollar yen and dollar CNH all has potential rooms for further gains.
I mean, we have been watching a potential intervention coming for the Japanese currency for a while now, but nothing has happened. Is that because the pace of deceleration hasn't been as fast?
Yes, Shery. So if we look at implied volatility, it is not yet at the extreme for the Japanese authorities to intervene. They've always emphasized it's always about the pace, not the level. So this is what we are seeing play out. But of course, markets are very touchy now, given that we have breakthrough the pivotal 160. And like you said earlier, everyone is calling maybe dollar yen to touch 170. So now the onus is really on the BOJ on the 31st of July to take back the narrative on the yen. And we do expect a BOJ hike to sort of fend off speculators in terms of the yen short in the market right now.
How closely are you watching the new currency chief, Atsushi Mimura?
So, he has been appointed to the Ministry of Finance, and we do think he's a steady hand. He has a lot of experience. But of course, given that the change of role, markets are a bit uncertain of what it will be his playbook. But overall, we do think that he will stick to the narrative of looking at the pace, not the levels. So the levels that I'm looking at now for the dollar yen will be the 164.50 level, which Kandar in January said a 10-yen move in a month would sort of trigger alarm bells among the MOF.
Alex, of course, we're approaching China's third plenum as well that's scheduled to take place in just a couple of weeks from now. Is there anything that you think we're going to get out of that could sort of change the direction for the Chinese yuan? The offshore, of course, very close to that 7.3 right now.
So we do have the plenum coming up. I think now authorities are in a sort of a blackout period and they're going to say anything substantive. But for the PBOC, it's an entirely different ballgame. They have to keep the Chinese yuan stronger against the dollar. So we do expect the fixings to be very robust, defending against any dollar strength. Because going into such a big political meeting, we think the PBOC do not want to see any excessive depreciation in the Chinese yuan. So we do expect a firmer fixing, in the lead up to the third plenum in 2 weeks' time. But as for the meeting, we do not think there will be any big bang economic reforms. The reforms will be more gradual, talking about household registrations, common prosperity themes, and of course there will be some highlights on the trade tensions that are building up against China from the G7.
Alex, we talk about the yuan, we talk about the yen a lot. Are we watching the Korean won as much as we should at this point?
It is very topical now, given the Korean won weakness. We just had the South Korea trade data come out. It's been very positive, and the trade outlook, South Korea trade has been picking up over the past first half. The PMIs are in expansionary, which is the positive too. So technically, nothing justifies the Korean won's weakness. So we think the Bank of Korea is really looking, to step in at the 1,004 level, and we did have, the Korean won going into extended trading hours, so there could be more volatility. So I do expect the Bank of Korea to watch the 1,400 level very closely in the coming weeks.
How close are you watching the crosses with Europe, given all of the political volatility that we're seeing there?
So we just had the first round exit polls, which sort of much played out as expected to the election polls, although the far right didn't win a majority, was positive to the markets. So we did see Euro catch a bit in the early trading session today. But overall, we think that, for Euro, do see more downside. It is not over yet. We do have the second round on Sunday. And if the far right or the far left, get a bigger majority than what the market expects, loose fiscal policy does put the French economy at risk. And, that may spill over to the Euro, which puts the ECB officials very uncomfortable, which we'll hear at the Central Conference this week.
Alex, good to have you with us, FX and macro strategist at TD Securities with all of his currency calls. And still ahead on the Asia trade, we take a look at China's tightening grip on Hong Kong as the Asian financial hub marks its 27th handover anniversary. That's next. This is Bloomberg.
You're taking a look at a live shot of Hong Kong. You might see grey on the screen with those clouds, but it's very much masking the weather out there today. We've got a prolonged heat warning in place. So people that are, of course, out of the office today for a public holiday, markets are shut. But we are marking as well the 27th anniversary of Hong Kong's return to China sovereignty. Bloomberg Originals has been looking at how the city is becoming more aligned with the mainland and what that means, of course, for its future as an Asian financial hub.
This was Hong Kong in 2019.
Some estimate that at their peak, 1 to 2 million Hong Kongers turned up to protest in a city of about 7 million people.
Where are they now? For years, Hong Kong showed how capitalism and Western values could coexist with China's wide-ranging economic reform. Now, the protesters are gone. What happened? And what does that mean for the city's future?
5 hours from now, the Union flag will be lowered and the flag of China will fly over Hong Kong.
When Hong Kong was handed back to China after more than 150 years of British colonial rule, Beijing promised a high degree of autonomy in its economic and political systems for 50 years. The city cemented its status as an international financial hub and one of the world's freest economies, bolstered by its rule of law, a free internet and press, and a currency pegged to the US dollar. It was the world's gateway to China's extraordinary industrial boom. But at the same time, tension had been simmering between Beijing and Hong Kong's political opposition, which wanted to expand civil liberties. Beijing continued to resist allowing Hong Kongers the right to choose their own leaders. And then, in 2019, Hong Kong proposed a bill to allow people to be extradited to mainland China to be tried.
And that triggered concerns that Beijing could use this legislation to clamp down on political dissent in Hong Kong.
Although protests began peacefully, the government's unwillingness to completely withdraw the bill caused demonstrations to escalate.
the demands from protesters morphed from just trying to prevent this bill from going through to demanding amnesty for protesters that had been arrested and calls for universal suffrage.
The movement continues through 2020 until
the government decided to roll out very strict pandemic control measures that essentially made it impossible to gather in large groups.
Within months, Beijing imposed a sweeping national security law, which punishes what Chinese authorities describe as secession, subversion, terrorism, and collusion with foreign and external forces. It also asserts broad powers to control sources of opposition.
Authorities then began to arrest people that they alleged were instrumental in the protests. And they also made it essentially impossible for Hong Kong's opposition parties to continue operating.
That also led to the shutdown of several pro-democracy outlets, including Jimmy Lai's newspaper, Apple Daily. It was just too much for some.
Since I left Hong Kong, I witnessed my friends from my industry, including theater actors, visual artists, got arrested or got charged. I felt really scared, and I felt this place is trying to expel its own people.
Jarita and her husband left Hong Kong in 2019 and now live and work in the UK. Some of her students are among the more than 140,000 Hong Kongers who emigrated to the UK after it rolled out a special visa scheme in 2021. Meanwhile, Beijing revamped the body that picks members of Hong Kong's Legislative Council to make sure only pro-China candidates can secure a seat.
Effectively, that meant that Hong Kong's government no longer had an opposition.
And in March this year, Hong Kong introduced its own security legislation. New crimes like treason and insurrection carry life sentences.
The threat to national security is real. So it is important we all bear that in mind, to be on guard all the time.
But it wasn't just increased restriction on free speech and expression, bringing Hong Kong closer to the mainland. Governments on both sides introduced programs to encourage Hong Kongers to study, work, and live in mainland China, and vice versa. Transport links have improved to support this. In 2017, President Xi Jinping unveiled the Greater Bay Area Development Project, an effort to integrate Hong Kong with Macau, Shenzhen, and nearby cities, starting with expanded infrastructure.
Things like the Hong Kong-Zhuhai-Macau Bridge, as well as the West Kowloon Station, which is integrated into Hong Kong's own subway and allows people to travel in less than 20 minutes from the city to Shenzhen.
And trips to mainland China hit record highs earlier this year. Some are embracing the growing ties. Born and raised in Hong Kong, 26-year-old Kaka took a job in Shenzhen after finishing her master's. Now she's working on starting her own business in mainland China.
其實我而家選擇去大陸生活最主要原因真係為咗方便。你出行首先就已經係非常之方便啦。你嗌滴滴啊，都已經係好快嘅一件事。平時喺香港可能嗌 Uber 嗰啲又貴啦又慢啦。第二就係俾錢，手機已經解決晒所有嘢。
With access to Chinese apps like WeChat and Alipay, Hong Kongers can now easily make transactions on the mainland. And it's dining and shopping that make up 70% of them.
呢度咧就係我哋今日去嘅第3個景點。哇！呢個米麻薯真係要影翻張相先。
Chinese consumer review platforms like Dianping and Xiaohongshu or Red, where users primarily post in Chinese, also help Hong Kongers navigate Shenzhen. To Kaka, all of this means that she can take advantage of the vastness of China's economy.
真心係好飲喎，
即係做 vlogger 我好簡單就係為咗錢嘅啫。 我自己就真係好坦白講啦，我對政治嘅一啲原因，我係冇咁 care 嘅。我唔係唔去了解，唔係唔想去睇，但係我覺得我了解咗，其實我做唔到啲乜嘢。年代氣息係啊。
The dilemma for Beijing is that the crackdown on political dissent has meant that people increasingly view Hong Kong as similar to mainland China. It's its differences that have really secured and underpinned the success of Hong Kong for many, many years, particularly its success as a financial hub.
Change in perception is important for everyone, particularly against a backdrop of geopolitical tensions and a significant economic slowdown on the mainland. Foreign businesses' direct investment into China last year slumped to levels not seen since the early 1990s, as trade frictions between Beijing and the US and its allies rose. Or look at the proceeds raised by companies through an IPO in Hong Kong. They are at their lowest in more than 2 decades. Hong Kong also lost its title of world's freest economy. Beijing needs Hong Kong so Chinese companies can raise money without tight capital controls, and it still has some of the deepest capital markets in Asia. But
one big question is whether Beijing is still getting everything that it needs from Hong Kong if there is a perception that these differences are no longer valuable to people, particularly to foreign investors.
Officials see things differently. Hong Kong Chief Executive John Lee has said the city's status as a financial center is highly stable, with 75% of the world's top 100 banks operating there. Some are optimistic for Hong Kong's future, despite uncertainties in the short term.
呢1、2年好坦白講，我未必話會選擇而家即刻返香港發展。但係未來嘅話咧，我覺得香港只會越嚟越好。所以我覺得呢一個返香港嘅打算絕對會喺我人生裡面發生咯。
But for people like Jarita, leaving the city for good was the answer to her discontent.
If I stay in Hong Kong, maybe I will still have a good career, but it's better that I leave because I don't want myself to be changed. I don't see a future that I like for me in Hong Kong.
And subscribers can see that documentary in full right now on the terminal on Bloomberg.com, and it's also available on the Bloomberg Originals YouTube channel. You can also listen to our Big Take Asia podcast on iHeartRadio, Apple Podcasts or Spotify as well. And we've got some live pictures, the events marking the 27th anniversary of the establishment of the SAR in Hong Kong right now underway. You're seeing a live shot there of the chief executive, Mr. John Lee, speaking at the reception for that. We'll have more ahead on the Asia trade. This is Bloomberg.
The latest corporate stories that we're following: BlackRock is buying private capital database provider Preqin for about $3.2 billion in cash. BlackRock says it expects to close the deal before year-end. Preqin founder Mark O'Hare will join BlackRock as a vice chair after the deal closes. Preqin competes with Bloomberg LP, the parent company of Bloomberg News. Sources say the U.S. Justice Department will charge Boeing with criminal fraud over 2 fatal 737 MAX crashes, leaving the plane maker to choose between pleading guilty or going to trial. We're told the DOJ will also fine Boeing more than $240 million and order 3 years of corporate monitoring. A lawyer for the crash's victims' family says it's a sweetheart deal for the company. Anglo American has suspended production at its coking coal mine in the Australian state of Queensland due to an underground fire. The company says all workers were safely evacuated from the Grosvenor mine after coal gas ignited on Saturday. Residents of nearby towns have been warned to stay indoors as thick smoke pours from the mine.
And Shery, of course, we're counting down to the start of trade here. We've got Taiwan opening at the top of the next hour, Chinese markets as well, mainland ones starting in just over 30 minutes as well. So far, we've got US futures. They're looking a little bit high here. We did see the Fed's preferred inflation gauge on Friday decelerating. So that's something, of course, the Fed wants to see, and it sort of sets the stage or helps to set the stage for easing later this year. As I said, Taiwan opening at the top of the next hour. That focus very much on chip numbers. We actually just saw for South Korea, chip exports hitting a record in June, but very chip-linked markets, the ties between them, and as well in the manufacturing PMIs, the private reading for Taiwan picking up to 53.2 from 50.9. So sentiment is improving versus what's happening in China, and those weaker PMI readings as well, Shery.
Yeah, we're watching the Chinese yuan, of course, as we head towards that market open, as we continue to see the pressure across Asian currencies. When it comes to the Japanese yen, we're at around 1986 lows against the U.S. dollar. The U.S. dollar is strengthening for 6 consecutive weeks. And we're watching also the Japanese yen cross against the euro because we continue to see those record lows declining at the moment after we saw those French parliamentary election results as well. This is Bloomberg.